Let's do a flow of cost problem with 4 jobs, and we're going to use job order costs, and we're going to track our costs by job so we know how much it costs us to make each job. If we make a job that costs us $45,000 and we sell it for $30,000, we won't be in business very long. It's really important we know how much it costs us to make our stuff so we can sell it for more than that. Remember, we're going to take direct materials, direct labor, and overhead and move it into work in process. Think of work in process as our factory floor. How are we going to know what the direct material dollars are? Well, Ralph's in charge of our supply area, so before people can check out direct materials to work on a project, they have to tell them which job they're working on. How do we know what the direct labor is? We look at the time cards and we can see that so-and-so worked on job number 25 for 8 hours today. The problem is manufacturing overhead. Those are indirect costs, like depreciation on our factory equipment. How much depreciation on our factory equipment goes into each job, we really can't say for sure, so we'll make up an overhead application rate to make a guess at how many dollars move out of overhead and get applied to work in process. We'll use that same overhead application rate, not just to move total overhead into work in process, but to apply overhead to specific jobs. This problem is about the month of January and 4 jobs at Aries Manufacturing. It tells us that at the beginning of the month there's a $5,000 balance in raw materials inventory. That's the wood, the metal, whatever it is that's sitting in the raw materials area that Ralph is in charge of. It also tells us that on January 1st we had job number 25 in process. So we're working on that job, and it has materials of $10,000, labor of $6,000, and overhead of $9,000 has been applied. So that means that our beginning work in process is $25,000. It also tells us that job 23 had previously been completed at a cost of $45,000. So that's sitting in finished goods waiting to be sold. Great, so now our T accounts are all set up to trace the costs that are incurred during the month of January. At the risk of repeating myself, materials, direct materials are easily traced because we just checked with Ralph. Labor, direct labor is easily traced because we can look at time cards. The challenge is manufacturing overhead, the indirect cost. We'll have to use a guess. And this company is going to use direct labor hours as its driver. It thinks that there is a direct connection between direct labor hours used and manufacturing overhead consumed. Before the year even starts, we all get together to come up with our rule. And the facts here are that our total overhead for the year is expected to be $450,000. The problem also tells us direct labor costs, but we don't care about that. Textbooks always do that. They give you extra information you don't need to calculate the manufacturing overhead application rate. It tells us the direct hours are 20,000. So we'll take the total manufacturing overhead divided by the driver and come up with an overhead application rate of $22.50 per direct labor hour. We'll use that number to apply total overhead to work in process and also to apply overhead to the specific jobs. The total overhead that gets applied to work in process is going to equal the sum of the overhead that got applied to specific jobs. All right, let's do some journal entries because life is best understood in terms of debits and credits. It tells us that we bought additional raw materials on account for $46,000. So we're going to debit raw materials for $46,000 and credit accounts payable for $46,000. It tells us that we incurred factory labor costs of $32,400. Well, some of that is direct labor, are people working directly on these jobs, and some of it is indirect labor. We can take $32,400 and subtract the total of direct labor, or we can take a little peek here and it tells us that indirect labor is $7,500. So we'll credit wages payable for the total that we owe, and the direct labor will go directly into work in process. The indirect labor will park itself down here in manufacturing overhead and eventually get applied with the other overhead costs via our overhead application. Next, the problem tells us that our indirect materials were $10,000. In other words, small little nails, small little brads, glue, sandpaper, little things that we're not going to bother to keep track of, total $10,000. We'll debit manufacturing overhead for those indirect materials and credit raw materials. So they come out of that little cage where Ralph is with all the materials, but we don't tell people, yeah, I'm using 4 nails on job 25 and 6 nails on job 26. We'll just take those indirect materials and move them down in manufacturing overhead and apply them using our manufacturing overhead rate. We had $7,500 of indirect labor. Those are supervisors or maybe quality control people or the janitor, people that aren't working directly on any particular job. But we already booked that when we credited wages payable and debited manufacturing overhead for $7,500 and work in process for the direct labor costs. So we don't have to book a journal entry for that now. We do have depreciation expense, so we're going to debit manufacturing overhead and credit accumulated depreciation. As you may remember from financial accounting, the journal entry for depreciation expense is usually debit depreciation expense, credit accumulated depreciation. But in this case, that depreciation expense is going to be part of our product cost rather than a period cost. So we're going to park it in manufacturing overhead, and again, it's going to get applied using our manufacturing overhead rate. Then the last overhead costs are $11,000. Maybe that's the utility bill that we're going to pay later. We debit manufacturing overhead for $11,000 and credit accounts payable for $11,000. All right, let's move direct materials onto the factory floor. We check with Ralph. He says that people checked out materials for job 25 of $5,000, for job 26 of $15,000, and for job number 27 of $13,000. So we debit work in process for $33,000. That's the total, and credit raw materials for $33,000. In beginning work in process is job number 25, which cost us $25,000 so far at the beginning of January. We've added in the new labor, the direct labor. We've added in the new materials, the direct material. What's left is the indirect labor, the indirect materials, and the other manufacturing overhead. And that's just a guess. Remember, our guess is $22.50 per direct labor hour. It tells us that the labor hours we used on the jobs during the month of January were 200 plus 800 plus 660, or 1,660 times 22.5 tells us that we're going to move a total of $37,350 of overhead out of overhead and apply it to the work in progress. Is that the exact correct amount of overhead? We don't know. We're just making a guess. And later on, we'll learn about making better guesses by breaking manufacturing overhead into activity pools. But right now, we're just using one activity pool and one overhead application rate. All right, let's take a look at our job order cost sheets to figure out what happens to the work in process, the finished goods, and the cost of goods sold account. Remember that job number 23 was finished before the month of January started. That's the $45,000 that's sitting in finished goods right now. There is no job 24 in this problem, but job number 25 was sitting in beginning work in process. It had $10,000 worth of materials, $6,000 worth of labor, and $9,000 worth of overhead that was incurred previously. That's in beginning work in process. And this month we added $5,000 of materials, $3,000 of labor, and $4,500 worth of overhead. How do we get that overhead that got applied to job number 25? Well, the problem tells us that on job number 25, we spent 200 direct labor hours during the month of January. 200 direct labor hours times $22.50 per direct labor hour means that the job got $4,500 of manufacturing overhead applied this month. The job is now finished, so we can add up our total cost, our total materials cost, are $15,000. That's $10,000 from December, $5,000 from January. Total labor is $9,000, $6,000 from January, $6,000 from December, $3,000 from January. And the manufacturing overhead that got applied is a total of $13,500, $9,000 from December and $4,500 from January. The problem tells us that job 25 got completed, so we'll debit finished goods for $37,500 and credit work in process for $37,500. That's what it costs us to make that job. We started and finished job 26 during January. $15,000 of direct materials, $12,000 of labor, Since the total direct labor hours were 800 on that job, 800 times 2250 means that manufacturing overhead of 18,000 got applied. Since that job is done, we can total the cost. It's 45,000. So we debit finished goods for 45,000 and credit work in process for 45,000. And what about job number 27? Well, during the month of January, we used $13,000 of direct materials, $9,900 of direct labor. Since the total direct labor hours on that job were 660 during January, 660 times 2250 means we applied overhead of 14,850. We can't total that job because it isn't done yet. It's an ending work in process. But if you add up those numbers so far, you should see that we spent $37,750 so far, and sure enough, that's our ending balance in work in process. That's the only job we're still working on at the end of January. So that $37,750 balance represents the cost we've invested so far in job number 27. All right, let's book the sale of job number 23. It tells us that we sold job number 23 for $65,000. We're going to get paid later, so debit accounts receivable, credit sales. I put the income statement accounts in red font. Remember, raw materials is inventory we're going to work on. Work in process is inventory we're working on, and finished goods is inventory we've finished working on. These numbers don't hit our income statement until we actually make a sale. So here we have $65,000 in sales. So we'll also have to take job number 23 out of finished goods and move it into cost of goods sold. So we'll debit cost of goods sold for $45,000 and credit finished goods inventory for $45,000. Let's sell job number 25 for $74,000. Why don't you pause this video and see if you can do the two journal entries, one to book the sale and one to book the cost of goods sold, selling job number 25 for a total sales price of $74,000. I hope you got it. We debit accounts receivable for the sale price of $74,000, credit sales for $74,000. Debit cost of goods sold for $37,500, credit finished goods for $37,500. So it cost us $37,500 and we sold it for $74,000. We sold it for more than what it cost us. And what's the balance left in the finished goods inventory? Add up all the debits, subtract all the credits, you get a balance of $45,000, which is job number 26. We started and finished it in January, and it's just sitting there waiting to be sold. Lastly, what's the balance in manufacturing overhead? Add up all the debits, subtract all the credits, and we have a debit balance of $3,150. So we spent, if you will, $40,500 on overhead, but we applied only $37,350. So this month it is underapplied. Hopefully it'll be overapplied next month, and when we get to the end of the period, whether it's the quarter or the 6-month point or the year, we'll close out manufacturing overhead into cost of goods sold, unless it's a big number, in which case we'll sprinkle it into cost of goods sold, finished goods, and work in process inventory. And that's all there is to job order costing.